Welcome into the Investing in Real Estate show. I'm Clayton Morris. So glad to have you here. I am the founder of Morris Invest, a full-service rental real estate company. I've done thousands of rental properties over the years, and this is our Q&A episode where we answer your questions. You can send us a question by going to morrisinvest.com/Clayton, and you can leave us a 30-second question about anything real estate related, finance related, taxes, etc., and we will attempt to point you in the right direction with some advice, and if we can't answer, we will certainly make sure that you get the expertise that you need to answer your question. All right, let's dive into today's questions. We've got three great ones here. The first one is up from Corey, so let's listen in to Corey's question.
Hey, Mr. Morris, this is Corey here. My question is more of a hypothetical that I kind of want to ask you about. I know you speak a lot about preferring real estate over investing into the market, i.e. using mutual funds and retirement accounts. So what I'm curious to see is, can you kind of run through a hypothetical of, let's say, a $200,000 investment into a good real estate rental property versus that same $200,000 into a mutual fund or a Roth IRA, and kind of compare the differences as you see them over the next, let's say, 10, 20, 30 years, and kind of break that down. Thank you. I appreciate your time.
Hey, thanks, Corey. And kind of a different question. I like the hypothetical question. So first of all, $200,000, right? He says, let's take $200,000 and put that into a rental real estate investment. Great. Here's what I would do is, first of all, I would take that $200,000, and in the case of like our company at Morris Invest, that would be like 4 rental properties you could buy. Because if a down payment is around $45,000, that $200,000 allows you to pick up basically 4 properties. Okay, so now you're picking up 4 properties with the down payment, and then the bank is carrying the rest. So first of all, just at a high level, 30,000 foot level, the difference between buying into a mutual fund with $200,000, it's a 1-for-1 conversion. So if I'm going to buy $200,000 of Ford stock or Coca-Cola stock in my mutual funds, right? That's $200,000 that's out of my pocket that's going into Ford. Now, with $200,000 of my own money, I'm able to then convert that. I'm able to take that even further, because now I'm going to get the bank to give me like a 5-to-1 return. I mean, it's the only investment where I can literally put up 20%, 25%, and then have a bank give me the other 80%. You can't get that with the stock market. Right? You cannot go to a broker and say, hey, I want to buy 100 shares of Apple, but I'm only going to give you enough for 20% of it. It's not going to happen, right? So what I would do if I had a 401k or I had some sort of other retirement vehicle that's sitting there in mutual funds, by the way, you're paying a lot in fees, right, to these money market managers that are managing your money. And at the end of the day, you're really only going to get a 2, 3, maybe 4% return in the stock market if you're lucky. And you're also not creating a performing asset. So with real estate, now that $200,000, I'm spitting off thousands of dollars a month in cash flow, right? So if I've got that, in this Corey situation, if I've picked up 4 rental properties that are each cash flowing $3,000 a month from 2 different tenants and 2 sides of a duplex, I mean, do the math on that, right? 3,000 times 4, now I'm looking at about $12,000 a month in cash flow. That's before expenses. And I'm able to do that and build my net worth because of a bank and conventional financing or non-traditional financing, right? And I've put up a certain percentage, and I've let the bank carry the rest at historically low interest rates. Not only that, I'm also getting the tax benefits of owning real estate, because I'm able to claim that depreciation on my taxes. And I cannot do that with mutual funds, okay? I cannot do that with stocks. So there are just some high-level differences. I'll also look at 10, 20, 30 years. That's what Corey was talking as well. Look at the volatility in the stock market. I mean, ups and downs, and you have no control over that. Now, with real estate, you can, because if you're buying in certain smart markets, which are a hedge against, which are, number one, a hedge against inflation, but also where you have population increase, you have job increases, you have low crime, you have low vacancy rates, you have a demand for property. We need to build 20 million homes in the United States because we have an affordable housing crisis in the United States. So Just the differences between the stock market and real estate are dramatic. And then if you're buying in certain markets where you are protected against this volatility that's in the US dollar right now. I mean, look at Venezuela this week. Their currency just collapsed. Okay, the bolivar just collapsed. And now they're actually turning to a digital currency. So they're actually using the dollar in Venezuela. And as I've always said, all government currency collapses at some point. It's just a matter of when. So do you want to have your money tied to these paper assets like the US dollar or the stock market? Or would you rather have a tangible, real asset that produces monthly cash flow and has historically been a hedge against inflation? So thank you for that great hypothetical, Corey. I could talk about that all morning. I could talk about that all afternoon, as you can tell. All right, here's our next question from Terry.
Hey, Clayton. My message is about the self-directed IRA. If I have $50,000 in an IRA and I want to make a down payment, I would need to finance the rest. So how would I make the payments on what I financed if all the income has to go back directly in the IRA? Thank you.
It's a great question, and our team, Terry, can handle that for you. We can set up a self-directed IRA at Morris Invest in a matter of a few minutes, but our team is specially set up to answer those specific questions on the self-directed IRA. So what you can do with a self-directed IRA is, you're right, use a portion of it as a down payment. So that $50,000 could be used to make the down payment, and then you would get conventional financing or non-recourse financing for the rest. And the way that would work is it would be structured separately and outside. So we can construct them differently depending on your unique situation. And that's where our team would come into play. And I don't want to give you a one-size-fits-all approach to that, but just book a call with our team at morrisinvest.com, and we'll walk you through that process, because it may be that we would set up non-recourse financing. Okay, you would then purchase that in an LLC. So you'd be buying the house in an LLC, and through non-recourse financing with the bank, your name personally wouldn't be tied to the loan. It would be the asset itself, paying that back through that LLC structure and through that separate bank account. Now, it gets a little funky on percentages, so that's why I want you to talk with our team, because every situation is different. When you have a certain percentage of expenses and things like that are coming out of a self-directed IRA, like if you bought the house fully in a self-directed IRA, taxes, expenses, any sort of maintenance item would have to come out of the self-directed IRA. You wouldn't be allowed to touch that. So again, there's not, one size-fits-all approach to this, Terry, but please book a call with us and we can walk you through the different structures and the percentages based on how much you have in a self-directed IRA and how much you would need to finance on the backside of it. But that's the beauty of real estate, is that you can mix and match these things. People don't even know that. Sometimes when they get on the phone with us, they don't even realize they've had $30,000 sitting in this old IRA that's just been sitting there doing nothing. Guess what? You could use that as the down payment, and then use conventional or non-recourse financing for the rest of it. There's a lot of different ways to slice and dice this thing. So thank you, Terry, for that question. Again, book a call with our team. We'll walk that process through and play with those percentages and see what your situation looks like, because everyone is different. All right, our next question comes from Leo.
Hey, Clayton, this is Leo from the state of Arizona. I'm currently a freshman in high school, looking to get started on my first investment property. So my confusion is, can you price rent on a rental property as what you would like it to be, or are there rules for that sort of thing? And the second part of my question is, I'm new at this. I really want to get into this. Do you have any advice that I should know, that I should do my due diligence on before I execute this plan that I have going on? Thank you, Clayton, and have a good rest of your day. Bye-bye.
Thank you, Leo. And I love that you're getting started with real estate investing at this age. Man, if I would have done that, would have saved me a lot of years of pain and anguish of dealing with, worrying about money and being in debt. So, congrats for being, in your high school years here and getting involved in rental real estate investing. That's awesome. My advice would be, number one, to just read as much as you can. Okay. Read and learn as much as you can. And also another piece of advice is, don't get caught up in shiny object syndrome. You might start with residential real estate investing like I do, like single family homes and duplexes, and that's been my bread and butter. I've been, people have been like, hey, why don't you invest in this 100-unit apartment complex? Why don't you come over here and invest in mobile home parks? Why don't you do this? Why don't you do that? And when you shift and start trying to be an expert in all things and trying to, swerve, you're going to fail. You're going to spread yourself too thin. So stick with one course of action, okay? Whether it's storage unit investing, raw land, tiny homes, residential real estate, like what I do, stick with it, okay? And once you've had one or two successes, you're going to start to think, maybe I should invest in 100-unit apartment complexes. It always happens like after the second or third property. You're like, maybe I'm good enough to do it. Don't do it. Okay, that's a strong piece of advice I would give you. Read as much as you can, to learn as much as you can about this process. But if you're in high school, I'm not going to make an assumption about your finances, but chances are you probably don't have like a boatload of capital or money to use right now to buy properties. So this is an opportunity for you to partner or to be that energetic dog with a bone and to find deals. If you're young, again, there's three ways to start getting invested in real estate. You need to have a deal, you need to have money, and you need to have friends. Okay. So if you don't have any of those things right now, you might have friends, you don't have money, and you don't have a deal, go out and find deals. Learn how to do wholesaling, learn how to hit the pavement, understand what goes into making a great transaction. And follow my other videos here on the channel where we talk about the things that we look for in a rental market, because we'll spend years analyzing a market. Like we just released a new video, we'll link it up here in the card for you to check out, about what we look for in our different rental markets. And we'll spend a long time. That's why we only build our new construction properties in certain towns, because we want to make sure there's low crime. We want to make sure that there's a high job demand, multiplicity of jobs there, not just one oil refinery, low crime, all of those things go into this process. So please listen to that video, watch that video, and don't deviate from that, because that's where you can get into real trouble once crime starts going up and jobs start going down. And let me come back to your rent question, your question on raising rents. I think you're putting the cart before the horse here. Rents are sort of market dictated. You can charge $2,000 a month in rent if you want to, but if everyone else in that neighborhood with a similar looking property is only charging $800 a month in rent, your property is probably going to sit there vacant forever. Okay, so the market will often dictate the rent and the type of property you have. So like with the properties that we build at Morris Invest, like we're doing high-end finishes. We're doing, stainless steel appliances and granite countertops and vaulted ceilings and, so very nice finishes. And that means we can and we're in great school districts, so we're able to command a higher rent. So those types of things are important. But I would turn that over to your property management company. A property management company is going to decide what that rent looks like in that town. And you should have a discussion with them every year. Can we raise rents, keep it steady, etc.? So that's really not going to be something you need to worry about yet. I think you're putting the cart before the horse on that, Leo. But I am excited for you. I'm really excited that you're taking action on this. Read Rich Dad, Poor Dad. Read Tom Wheelwright's great book, Tax-Free Wealth. Read The Loopholes of Real Estate Investing by Garrett Sutton. Those 3 books, that should be your foundation. And heck, read my book too, How to Pay Off Your Mortgage in 5 Years, because there's a lot of really interesting things in there about understanding the mortgage structure and how to turn assets into performing assets. So thanks everyone for your great questions. I would love for you to leave me a question. You can go to our website, morrisinvest.com/Clayton. And that's how you can leave us a 30-second question right here on the show, and I will answer them. And if you are ready to get started with rental real estate and you want a team that's going to handle everything for you, book a call with our team. We'll jump on the phone with you for 30 minutes and we'll answer your questions and get you started. Just go to morrisinvest.com. Now take action, everyone. Go out there, become a real estate investor, just like Leo at a young age, because I believe it's the #1 way to build wealth. We'll see you next time.